Welcome! In today's video of Investor News, we're going to talk about Wolfe Research's latest report. According to Wolfe Research, it's time for investors to snap up defensive dividend stocks as a recession could hit later this year. Wolfe analysts said in a note Monday that they believe a recession could turn up as early as the fourth quarter, though they maintained that their base case is for a downturn in 2023. Before we get into more detail about it, don't forget we have a bonus fact for you at the end of the video. Wolfe Research. Wolfe Research is a rapidly growing, institutionally focused Wall Street equity research firm that have been voted within the top 15 equity research firms on Wall Street by clients for the past 5 years in Institutional Investor Magazine's All-America Research poll, most recently placing 5th in the poll as we continue our steady advance higher. Today, Wolfe Research is home to more than leading 25 analysts covering a wide range of sectors. The firm's clients include many of the world's largest asset managers with mutual funds, pensions, and hedge funds as the primary constituents. In addition to research, the firm also offers sales, trading, and investment banking services to institutional clients. To understand what the report means, you first need to know in detail what recession and defensive stocks are and why now is the time to invest in them. What is a recession? A recession is a significant decline in economic activity that lasts for months or even years. Experts declare a recession when a nation's economy experiences negative gross domestic product or GDP, rising levels of unemployment, falling retail sales, and contracting measures of income and manufacturing for an extended period of time. Recessions are considered an unavoidable part of the business cycle or the regular cadence of expansion and contraction that occurs in a nation's economy. During a recession, the economy struggles, people lose work, companies make fewer sales, and the country's overall economic output declines. The point where the economy officially falls into a recession depends on a variety of factors. Causes: a sudden economic shock. An economic shock is a surprise problem that creates serious financial damage. The coronavirus outbreak, which shut down economies worldwide, is a more recent example of a sudden economic shock. Excessive debt. When individuals or businesses take on too much debt, the cost of servicing the debt can grow to the point where they can't pay their bills. Growing debt defaults and bankruptcies then capsize the economy. Too much inflation. Inflation is the steady, upward trend in prices over time. Inflation isn't a bad thing per se, but excessive inflation is a dangerous phenomenon. Central banks control inflation by rising interest rates, and higher interest rates depress economic activity. Too much deflation. While runaway inflation can create a recession, deflation can be even worse. Deflation is when prices decline over time, which causes wages to contract, which further depresses prices. When a deflationary feedback loop gets out of hand, people and businesses stop spending, which undermines the economy. What is a defensive stock? A defensive stock is a stock that demonstrates relatively stable performance regardless of the current state of the economy. Defensive stocks are also called non-cyclical stocks, as they are less prone to the economic cycle of expansions and recessions. Defensive stocks will come with a steady dividend payment and a more constant share price. During an unexpected recession, investors usually add defensive stock to their portfolios as they are expected to perform well despite the economic downturn. On the other hand, cyclical stocks mirror the economic cycle by thriving during economic upswings and suffering during a downswing. Identifying defensive stocks. Beta measures a stock's volatility in relation to the overall market. Defensive stocks usually come with a low beta because they are less affected by market swings. Defensive stocks are traditionally come from sectors that produce necessities or consumer staples. Consumers who purchase such goods or services will do so regardless of a recession. They also won't buy excess goods or services even if money is available to spend if the economy is booming. Advantages. Defensive stocks offer the substantial benefit of similar long-term gains with lower risk than other stocks. Defensive stocks as a group have a higher Sharpe ratio than the stock market as a whole. That is a strong argument that defensive stocks are objectively better investments than other stocks. Warren Buffett also became one of the greatest investors of all time in part by focusing on defensive stocks. It is not necessary to take excessive risks to beat the market. In fact, limiting losses with defensive stocks may be more effective. Disadvantages. On the downside, the low volatility of defensive stocks often leads to smaller gains during bull markets and a cycle of mistiming the market. Unfortunately, many investors abandon defensive stocks out of frustration with underperformance late in a bull market, when they really need them the most. After a downturn in the market, investors sometimes rush into defensive stocks even though it is too late. These failed attempts at market timing using defensive stocks can significantly lower the rate of return for investors. Examples of defensive stocks. Number 1. Utilities. Water, gas, and electric utilities are examples of defensive stocks because people need them during all phases of the business cycle. Number 2. Consumer staples. Companies that produce or distribute consumer staples, which are goods people tend to buy out of necessity regardless of economic conditions, are generally thought to be defensive. They include food, beverages, hygiene products, tobacco, and certain household items. These companies generate steady cash flow and predictable earnings during strong and weak economies. Number 3. Healthcare stocks. Shares of major pharmaceutical companies and medical device makers have historically been considered defensive stocks. After all, there will always be sick people in need of care. However, increased competition from new drugs and uncertainty surrounding regulations mean that they aren't as defensive as they once were. Number 4. Apartment rates. Apartment real estate investment trusts, or REITs, are also deemed defensive, as people always need shelter. When looking for defensive plays, steer clear of REITs that focus on ultra-high-end apartments. Also, avoid office building REITs or industrial park REITs, which could see defaults on leases rise when business slows. Thank you for staying with us throughout the video, dear viewers. It's now time for the promised bonus fact. Did you know the average length of recessions going all the way back to 1857 is less than 17.5 months? The longest post-World War II recession was the Great Recession, which began December 2007 and ended in June 2009, a total of 18 months. What do you think about Wolfe Research's report? Let us know what you think in the comment section below. And that's a wrap. Don't forget to like, subscribe, and leave a comment before leaving. And we will be back with more news like this soon.